Okay, so the next topic of discussion is capital structure theories. Now, this topic is of a philosophical point like that. In the sense, you can have various sources of finance, right? You can have equity, you can have debt, you can have preference share, you can have bank loan, you can have venture capital, various ways you can get the money. But what is the best mixture? Because ultimately in life or in a profession, going to extreme is always bad. That is, you can't say that this is always good, equity is always good, debt is always good. We cannot make a conclusion like that. You always need a combination. So these theories will tell you what is the best way in which the debt, equity, preference, etc. can be mixed. What should be the best mix of debt and equity so that the business owners get the maximum value, maximum benefit. These are all called theories because there is no one specific angle into it. Now, if I ask you one question, is loan, or we call it as debt, good or bad? Some people say debt is bad. Why should we take loan? Why should we take loan? We'll only earn money. Let's have salary. Then we'll enjoy out of it. If you say debt is bad, then you are keeping the money in the bank. Bank is giving you interest, right? Where will bank get the money from? According to you, if you say debt is bad, that means everybody in the world should not take debt. Then what should bank do? Just keep the money with them. Where do they earn money? Where do they earn interest for you to pay saving bank interest? According to, if nobody takes loan in the world, then banks have done job. Banks cannot to pay you interest. Then you can't still say no, I want interest. That is not possible, right? So you can say debt is not good for me. Does not mean debt is not good for everyone else. Or you can say a debt is good, but to an extent. Did you see that? Now we are having difference of opinions here. Some people say debt is bad, or some people say, wow, debt is a good opportunity. I have an opportunity in my business. I need to manufacture more number of units. I need money. Reliance, Geo decided I'm going to give free to my customers. I will acquire customers. I'll make profit afterwards. So lot of cost involved, installations involved, towers to be built, telecommunication network should be there, team should be there. You take the help of debt. You have taken loan. You can also raise equity. That is another matter. But the point here is some people may say debt is good. Some people say debt is bad, or some people say debt is good up to an extent. To what extent? That depends on your personal level. Therefore, the different points of view exist regarding the type of capital to be deployed in a business. Company like Infosys don't take loan. Company like Adani takes huge amount of loan. And you can't say that Adani is bad. If all the people who take loan are bad, then what will bank do? If bank cannot give loan, then you cannot earn interest. You see the chain activities. You can't say that one thing is always good or one thing is always bad completely. Every point of view should exist. Okay, so that is what we are going to discuss now. Different theories exist here, telling their points of view. There can be conflicting theories also. Practically, depending on the situation you live in, you have to apply the respective concept and make a decision out of it. So essentially, so let's write down the meaning of capital structure. Capital structure. Write down. This refers to the mix of debt equity and other types of finance and other types mix of debt, equity and other types of source of capital and other types of source of capital. Capital structure theories. These are various points of view, various points of views, various points of views on impact of different types of capital, various impact of different types of capital, different types of capital on company financial position, on company financial position. We have broadly four types of theories. One, we have net income approach. Next, we have net operating income approach. Then we have M&M approach. It's called as Modigliani-Miller. As of now, you can write short form M&M approach. Net income, net operating income, M&M approach, Modigliani-Miller. And last one, traditional approach. Traditional approach. Write down till here. Okay. I hope you have written till here. Okay. So before we go to the theories one by one, a few basic points to be kept in mind. So a few basic points, let's keep it in mind, basic points. And then we'll go to the theories one by one. Okay, now just think of this. If I say I have a fixed deposit of 1 lakh and rate of interest is 8%. What is the annual income I get? Annual interest I get. Annual interest income. 1 lakh is the fixed deposit, 8% rate of interest. Very simple. 1 lakh into 8%, that is 8,000. Simple, right? 1 lakh into 8%, 8,000. Now, if I tell you, I need annual interest income of 16,000. Rate of interest is 8%. How much do you think I need to have in fixed deposit? 2 lakhs? Very simple, double. 8 lakh, double I need 16,000. So I should put double, 1 lakh, double, 2 lakh. But mathematically, I want to get it in a different way. How do I get that? Can I say like this? 16,000 divided by 8% gives me 2 lakh. One way understanding is correct. 8,000 double, I get 16,000. Other way is 16,000 divided by 8%, I get same 1 lakh. So if I want not 16,000, I want 12,000. 12,000 by 8%. I want 14,000. 14,000 by 8%. I want 17,000. 17,000 by 8%. Yes, you get the answer. That is 1 lakh, 16,000 divided by 8%, and that's how I get FD of 2 lakh. Okay, now other way of question. If I give you fixed deposit is to 1 lakh, interest income, annual income, you get 7,500 or let's say 7,000. Then what should be the rate of interest? On 1 lakh, if I get 7,000, what should be the rate of interest? 7,000 divided by 1 lakh, 7%. If I say 7,000. And how did I calculate that 7,000, 7%? 7,000 is the interest income divided by 1 lakh, and to express in percentage, I multiplied by 100. That's where I get 7%. So what is the basic point I want to keep this in mind is to compute interest, to compute annual income, what do we do is value of investment multiplied by rate of interest, or I'll just say percentage. You understand? Value of investment multiplied by percentage rate. And to compute the value of investments, to compute the value of investment, what we do is whatever is the annual income divided by the percentage rate. To compute the income, we multiplied by the percentage rate. To compute the value of investment, we divide by the percentage rate. Or I can write here, divided by percentage rate. Annual income divided by percentage rate. And but if I want to compute the percentage rate itself, to compute the percentage rate, it is annual income divided by value of investment into 100. Okay, write down only what is there at the bottom. The numerical example, you leave it. Only what is there at the bottom, you write it. Compute the annual income, value of investment into percentage rate. To compute the value of investment, annual income divided by percentage rate. To compute the percentage rate, annual income divided by value of investment. Okay. Hope you have written down that part. Okay. 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 So what we have understood now is the basic mathematical calculation, not any formula as such. Okay. Relevant to the capital structure theories, few small points or formats I would say to be kept in mind. So I'll write the format, then you can write it down. So we have going to write two statements. One is called the income statement, and other is called as the valuation statement. Let me write, then you can write down. I'll give you the time, don't worry. Income statement, we will write like this. We'll start with EBIT. I hope you know the full form of this. Earnings before interest and tax, EBIT, minus interest. What I get is earnings before tax. And then I subtract tax. And what I get is profit after tax. This EBIT is also called as net operating income. Net operating income. And this PAT, profit after tax, is also called as net income. Net income. Okay. Then we have valuation statement, which we call it as value of firm, and then we get value of debt. When I subtract, what I get is, I'll just write it here because it's connected with that, and it is called as value of equity. And how do I get the value of the firm? EBIT divided by KO. KO means overall cost of capital. You can say WSCC. How much you get the interest from the interest? You can get the value of debt. You can divide it by KD. And similarly, PAT, profit after tax, if I divide by cost of equity, I will get value of equity. So there are three broad structure to this format. One is the income statement, The other is the valuation statement. The example I gave you for fixed deposit, right? The income statement is the annual income. Valuation statement is the value of investment. And what connects the two is rate of interest. And we are having different rates here, different percentage here. So EBIT, I divide by the rate. You remember the basics. Income divide by the percentage rate will give you the value of investment. So net operating income divided by the cost of capital, overall cost of capital KO will give you the value of the firm. Interest divided by cost of debt will give you value of debt. Net income divided by KE will give you the value of equity. It can be any other permutation combinations. If I know net income, I divide by cost of equity, I get the value of equity. If I know the value of equity and cost of equity, if I multiply these two, I get net income. The basic rule, keep it in mind. If I know the value of investment, I know the rate of interest. If I multiply both, I will get the annual income, corresponding annual income. Yeah. So keep that in mind and write down this statement. The formulas are what I gave you is only to make you understand these calculations only. So you don't have to write down those formula anywhere. Those are only for your understanding. What is required for solving problem is this format. Okay. So I hope you have written down one small practical example only I will take. We'll fill up the format in this case. So I hope it is done till here. Can I take that one small illustration? Okay, great. Okay, let's take a consideration like this. Two basic facts. Let's say you have a apartment, house property. Okay, the apartment value is, let's say, 50 lakhs, and you have taken loan to buy the house worth 20 lakhs, and rate of interest of loan is, let's say, 8%. And this property, you have let it out on rental income, annual annual rental income of, let's say, 5 lakh. Okay, if these are the basic facts, looks practical. You have purchased house property for a value of 50 lakh. You have taken a loan of 20 lakh. Interest you are paying 8%. Rental income of 5 lakh. Every year from the house property, you get a income of 5 lakh. If I prepare the statement what I prepared, how does it look? You please write parallelly along with me. Income statement. Then valuation statement. In this problem, no tax. And many theory also assumes no tax. So what I'm going to write? EBIT is also called as net operating income. I'm using those short forms. Hope you're able to follow. Net operating income less interest gives me net income, nothing but profit before tax, but no tax. So straight away I can say net income, which is profit after tax. So we divide by cost of capital. We divided by cost of debt, and we divided by cost of equity, and therefore what value we get is value of the firm minus the value of debt, which will give us the value of equity. Okay, you write down, you tell me which amount I can write in which column. One amount by one amount you can take. The apartment value 50 lakh, and that is the value of the firm 50 lakh. When I say business, it is like a value of the house. Whether the house I have putting my money or I have taken a loan, value of the house is value of the house. So value of a business, value of a company, that is called as value of an entity, value of the firm. House property value is 50 lakhs, out of which I have taken a loan of 20 lakhs. So if I take out 20 lakh, balance amount, how it would have been obtained? I have purchased house property worth 50 lakh. 20 lakh is taken from loan, and balance money, I must have used my own resources, my savings, my own money, and that is called as equity, called as net worth, 30 lakh. Hope you're able to connect it practically also, not just these uh, technical terms. The value of the firm is nothing but the value of house property. Value of debt is the amount of loan you have taken. Value of equity means own money, net worth, how much money you're putting in out of your pocket, your savings. That is called as value of equity. And how much is net operating income? How much annual income you're generating from the house property is 5 lakh. Net operating income, 5 lakh. How much interest you're paying? Can you tell me how much interest I'm paying in this case? I've taken a loan of 20 lakh and rate of interest is 8%. 1,60,000. And how do I get that 1,60,000? 20 lakh multiplied by 8%. And what is the logic you have applied? I just told you, right? If I want to compute an annual amount like annual income or annual interest, the value of investment will be multiplied by the rate. So 20 lakh is the value of debt. You multiply it by the rate, which in this case is cost of debt. So 20 lakh into 8%. That's how you get 1,60,000. And therefore what you get is net income. So what is net income? 5 lakh minus 1,60,000, 3,40,000 is net income. That is what net income available to you after paying interest from your rental income. Now, how do we calculate cost of capital? How do we calculate cost of equity? Basic concept, do you remember? How did we calculate? If I want to calculate an income, the percentage is multiplied. If you want to calculate the value of investment, the percentage is divided. If I want to calculate the percentage itself, then annual income divided by investment. So for overall cost of capital, my annual income is 5 lakh. Overall cost of capital, overall business, from the overall house property point of view, 5 lakh is what I'm generating from 50 lakh. So net operating income and the value of the firm are connected. So overall cost of capital is calculated as 5 lakh divided by 50 lakh to express in percentage multiplied by 100, that is 10%. Similarly, cost of equity, you have invested out of pocket 30 lakh and you are generating 3,40,000, and therefore it is 3,40,000 divided by 30 lakh income divided by investment into 100. 11.33%. So this is the format you can calculate either cost of capital, cost of debt, cost of equity. In the exam, we don't know which data they give and which we have to calculate. But the structure is this, concept is this. Okay, I hope you written down all these numbers. If you get the overall basic concept and the format, any numerical comes, you'll be able to follow this format. And over a period of time, once you're comfortable, this format also not required. Basic concept only you can build. Debt plus equity is firm, firm minus debt is equity, any permutation combinations you can arrive at it. Rate of interest. Rate of interest is cost of debt. Okay, so now I'll go to the actual concepts of this chapter. So whatever I've done so far is just the basic introduction. Now I will go to the chapter heading to justify capital structure theories. I've given you 4 theories. Let us take it one by one. The first theory is called as net income approach. Net income approach. Okay, so what does this net income approach say? This basically says taking loan is good. Why taking loan is good? See, broadly, these are all assumes only two types of source: cost, debt, and equity. They don't talk about preferences and all, because when you want to prove something, Too many variables means you cannot make a proper analysis. So all these approaches assume only equity and debt, and they assume no tax also, and assume market is perfect, investors are rational. Certain assumptions are there, that is there in the material, you can go through it. Let's focus on the important points. So broadly, we have debt and equity. Debt is a borrowed money, equity is a own money. So think from company point of view, who will take more risk? The people who give money to the company takes more risk, or the company who run the business, that is shareholders. Like if you start a business, okay, if you start a business and you put your money, own money, into a business, or and you take loan, that means on one hand you are there who is running the business, on the other hand bank is there. Between the two, who will take more risk? You are giving up the job, sacrificing everything, doing business, let's say restaurant business. We don't know how many customers will come. More customer can come, less customer can come, COVID can happen, you may have to close down, and bank will come and say, I've given the money to you, you pay me interest. So who is taking the more risk here? Or therefore who should expect more return? Obviously the bank has given only loan, and therefore bank expects only interest, but you are the business owner is taking more risk, and therefore you expect more return. That is, for a bank, I mean from business point of view, what you get from bank is called as cost of debt, and your own money is called as cost of equity. So between the two, which one is higher? Normally, it will be the cost of equity, because the risk taken by the equity shareholder is higher than the debt holders. People who have variable income take more risk than the people take fixed income. And therefore, between the cost of equity and cost of debt, cost of equity will be costlier, cost of debt is cheaper. Overall cost of capital is average. Since cost of debt is cheaper, what this theory says, take more and more loan, proportion of loan. When I say more and more loan, it means more proportion of loan. That is, instead of keeping 100% equity and zero debt, you make 50 equity, 50 debt. Proportion. In that way, what happens? The cost of equity is a costlier source of finance, reduced. Cost of debt is a cheaper source of finance, increased. Overall average will be less. When there are multiple factors, one of them which is causing the higher cost, reduce it. Causing a cheaper cost, cost of debt, increasing it. So average, the overall cost will come down, is the theory what the net income approach says. So we'll quickly write down between generally between cost of debt and cost of equity, the cheaper source is cost of debt, hence increasing the proportion of debt will reduce overall cost of capital. Generally, between cost of debt and cost of equity, cheaper source is cost of debt. Hence, increasing the proportion of debt will reduce overall cost of capital. We have a chart also to cover this. X-axis talks about proportion of debt, and y-axis talks about the various cost of capital. Of course, we start with 0. So as you move from left to right, the proportion of debt increase. From top to bottom, the cost of capital. The lowest cost of capital is the cost of debt, AD. And the highest cost, costliest one is the cost of equity. And overall cost is a average. Average is always in between. The cost of equity is higher, cost of debt is cheaper. In between, the average comes. Average is overall cost of capital. And as you increase the proportion of debt, overall cost of capital comes down. This is what? Oh, draw a curve kind of thing. Overall cost of capital keeps reducing because the proportion of debt increasing. A cheaper source of finance is debt proportion. So mathematically, overall cost of capital comes down. So write down these 2 points and the chart. Okay, I'll go further. This is net income approach. There are some criticism against this, which is covered under next approach. So I will come to this. So basically, this proportion says, or this fourth is, as and when you add more proportion of debt, the cost of capital comes down, the value of the firm increase, is what this approach says. I'll go further. Next one is net operating income approach. NOI, net operating income approach. So this approach says there is some flaw in net income approach. What is that flaw? I understand that cost of debt is a cheaper source of finance. I agree. But when a company takes more and more proportion of debt, the debt people may not feel the risk, but the equity shareholders will feel the risk, right? You getting the point? If Adani keeps taking more and more loan, Adani shareholder will feel the heat because they have to pay interest. And if business does not turn out well, they have to pay out of their pocket. In the sense of what remains to the equity shareholders will be less and less. In the sense, when company takes more and more loan, the equity shareholders will feel bad, or it should feel bad. In the sense, their risk will go up. And when their risk will go up, what will happen? They expect higher rate of return. So imagine two companies. One company do not take loan. Other company takes loan. So where will you expect more rate of return? They are taking loan. They are taking risk. I am at more risk now. So a company which is leveraged, company which is taking loan, company which is taking debt is under risk as a shareholder. Therefore, I expect higher rate of return. So what is happening? As you increase the proportion of debt, there is one benefit because cost of debt is a cheaper source, cost will come down, but because of higher risk impact, the equity shareholder expects higher return. As a result, the cost of capital increase. So one positive impact, one negative impact, ultimately overall cost of capital remains same. Value of the firm remains same is what this approach tells. Let's write down, then we'll put the graph. Okay, so here this approach says higher the proportion of debt, higher proportion of debt would imply higher risk for a equity shareholder. Higher risk for a equity shareholder. So benefit of cheaper source of finance of debt. Cheaper source of finance of debt is compensated by increase in expected return, increase in expected return by shareholders. So one hand it comes down, other hand they increase because of the risk taken. The shareholder expect more return, so cost of equity increase. Overall cost of capital remains same. Value of the firm is not affected whether you take loan or not. House property is not affected. This is also logical. If you take more loan or less loan, that is your personal problem. The house property value is not affected, right? That's what this says. Value of the firm is not affected. Overall cost of capital, let me write this in the graph. Percent proportion of debt and various costs of capital. Cost of debt is a cheaper source. This is of course origin. Cost of debt is a cheaper source. Cost of equity is a costlier source, but it keeps increasing. It keeps increasing because when you take more debt, equity shareholders will feel more risk. They expect higher returns. As a result, overall cost of capital remains same, does not change. These are all theories. I mean, in the sense, none of them is perfect, but every theory has a point to convey. Correct. In net income approach, they assume that cost of equity will be same is an assumption that net operating income questions. When company takes more and more loan, how can you say that the shareholders' expectation will not change? In net income approach, assumption is cost of equity remains same. In net operating income approach, the assumption is cost of equity increases as you take more debt. Yes, that is a difference in assumption. Okay, that is net income approach and net operating income approach. Then we have something called as M and M approach, Modigliani and Miller. M and M. Please don't pronounce it as Modigliani and all. However, you may like or hate him. Modigliani and Miller approach. Okay, this approach supports the net operating income approach. What do you mean by that? The value of the firm is not affected by whether company takes debt or does not take debt. In a way, it is correct also. As I just told you, whether you take loan or not, house property value cannot change. You take more loan, when you sell, other person might take less loan. So capital structure theory is a financial decision. Value of the asset, value of the business is not affected by it. That's what this person also says. But he also give some behavioral approach and evidence to that. It's called as a arbitrage approach. What he says is this: if there are two shops next to each other, there are two shops next to each other, and they sell one common product, one Pepsodent and one Pepsodent. There is no difference in the quality. Same product they sell. If there are two entities selling the same product next to each other, their price will be same. It is like telling NSE price and BSE price. You know, in stock market in India, there are two important stock exchange, NSE, BSE. It's a market basically. So Infosys share will be bought and sold in NSE also. Infosys share will be bought and sold BSE also. Because of two markets, the price should be same between the two. It cannot be that Infosys share in NSE is 1000, BSE is 1500. If that is the case, what will happen? They will buy at 1000, sell at 1500. Both ways, Infosys share only. There is no quality differential. You can't say that, oh, BSE Infosys share is more quality. No, it is ultimately Infosys share. You will find 1000 rupee 0.5 paisa, 1000 rupee 0.3 30 paisa. I mean, only that much difference will be there. More than that, difference will not be there. If it exists, what will happen? Where there is a cheaper price, people go and buy. Higher price, people go and sell. Due to demand and supply, equilibrium will be maintained. That's the approach he also says. The value of the firm taking debt. Value of the firm do not take debt. He says there might be temporary difference between the two. But over a period of time, the value of the firm remains same. But it's a behavioral approach. We don't have to think too much about it. But there is one formula which he gives, especially when there is tax. That is important for us, especially from exam point of view. We'll focus on that. So, other two approaches, net income approach, net operating income approach, do not provide formula for tax impact. This person provides. So MM approach supports NOI approach, which basically means value of the firm is not affected by its capital structure. Whether you take debt or equity, value of the firm is same conceptually. Also explain behavioral evidence. I told you that between two shops, if the prices are different, because of demand and supply, ultimately the price has to maintain. That's what the behavioral approach called as arbitrage approach. Also explain behavioral evidence to prove the argument. To prove the argument. But more importantly, formula wise, without taxes, and more importantly, this formula with tax. Without taxes, value of the firm is value of levered firm is equal to value of unlevered firm. Value of levered firm is equal to value of unlevered firm. Levered firm means who takes loan, who takes debt. Company with debt. Firm, levered means with debt. With loan, debt means loan, with debt. Unlevered firm means no debt, means only equity, only own money. Some people are also like that. I am not going to take any loan. I want freedom in life. No loan, only my own savings. That is unlevered form. Only equity, no debt. And as per this approach, he supports the previous approach, telling levered firm, unlevered firm, both are same. Cost of capital does not have any impact. With taxes, he says one small thing. When you take loan, you have interest. Now, interest you can claim as expense for calculating income tax. So, tax will fall. So, you have a tax benefit when you take a loan, and when you have your own money, the tax benefit is not there. So, he says with taxes, that one small point will be enjoyed by company taking debt. With taxes, he gives the formula value of levered firm is equal to value of unlevered firm plus whatever the amount of debt multiplied by tax rate. The amount of loan what they take. That's the benefit a company taking loan will enjoy. A benefit not available company who is not taking loan. And what benefit? When you take a loan, you pay interest expense. When you have equity share, you pay dividend. But dividend is not an expense as far as the computation of income tax is concerned. Interest is an expense. So when you have interest expense, your profit will come down, which means you pay less tax. So the tax benefit is there, which is not there for a company who is not taking loan. They say the M&M approach say there's an extra benefit which is available to the levered firm, which is not available to the unlevered firm. And numericals, when we come to the problems, we'll handle important from exam point of view. Okay, one last approach is there. That does not require any formula. Actually, formula will come, but slightly later. But one small, they try to explain their own point also, we should discuss it. So if you're written till here, I'll go to the last approach called as traditional approach. Okay, one last approach I'll take it. Traditional approach. So what this approach says is they draw a intermediary line between net income approach and net operating income approach. So what did net income approach told? You should take debt. That will reduce the cost. And what is net operating income approach told? It does not matter. So two extreme view, right? One says who's good, other says don't care. Two extreme views. So what this approach says is, let's draw an intermediary opinion who says like this. I start with net income approach. When you increase the proportion of debt, the cost of capital comes down. I agree with you. And this approach also says when net operating income approach argues, cost of equity will not remain same. Cost of equity will increase. He says, I also agree with you. Then what is your point? It says up to certain point, the cost of capital reduce because of the cheaper source of finance, where the cost of equity will not increase. Why? The shareholders will not be affected up to a point. So if company takes small loan, shareholders are not worried. If they take little bit more loan, shareholders are not worried. But after a particular point, the shareholder starts worrying. That is when these people say cost of equity starts increasing. I will agree with net operating income approach. So this approach says there is a benefit of debt, but up to a point after which the debt becomes detrimental. It becomes negative impact. And what is that point? These people don't give any formula. That you figure it out. That you figure out depending on the context in which company you're working in, or whatever the context company's position is there. But you should always balance it out. You cannot say debt is good or debt is completely bad. You have to maintain a balance. So traditional approach says this approach draws intermediary position between NI approach and NOI approach. This approach draws intermediary position between NI approach and NOI approach. Is traditional approach followed by companies? Which company follows? Left to them, but they make decision. But definitely they keep these points in mind. But this approach does not give any formula, right? This is intuitively correct. So most of them follows. Not only company, you only do it individually, right? You take debt up to a point, you feel you are comfortable. Up to what point? Nobody can give a formula. Is it followed practically? I would say yes. How much mathematically? I cannot say an answer there. Okay. So it draws intermediary position between NOI approach, NOI approach. So as per this approach, cost of capital reduces. Cost of capital reduces up to a point. Up to a point. You can say this is called as optimum point. Optimum point of capital structure. As per this approach, cost of capital reduces up to a point after which cost of capital increase, after which cost of capital increase because of higher risk perceived by equity shareholders, perceived by equity shareholders due to high debt. I'll read it. As per this approach, cost of capital reduces up to a point, within brackets you can say optimum point of capital structure, after which the cost of capital increase because of higher risk perceived by equity shareholders, higher risk perceived by equity shareholders due to higher debt, due to higher debt. So quickly I'll write the chart. 0, this is proportion of debt, and this is cost of capital. Cost of debt remains flat. Cost of equity remains flat up to a point. Cost of equity does not change, but after a particular point, cost of equity starts increasing, where equity shareholders will feel the heat of risk. So up to the point, cost of equity remains same. The overall cost of capital starts coming down, and after a particular point, overall cost of capital increases. So this point where it minimum cost of capital, right? So this is what is called as optimum point. And what is that optimum point? No formula exists. That depends on very specific individual company preferences. Okay, great. Few more small concepts are also there. Some formulas like indifference point is there. Financial break-even point is there. And next concept also we have something called as leverages, where some formula also will come. Anyway, good.